Imagine a world where banks are literally creating money out of thin air, not to fund a new business or help families, but simply to hide the fact that they are running out of cash. This isn't a conspiracy theory, this is the reality right now in China, where banks are desperately pumping out billions of dollars in fake credit, phantom loans that never actually reach real businesses. They are doing this just to hit arbitrary government targets amidst an economy that is crumbling. This practice isn't just dishonest, it's an extreme form of financial maneuvering, essentially cooking the books to mask a collapsing system. This should scare every American investor and consumer because credit is the absolute blood life of any system built on debt. What's happening overseas confirms a warning we have been giving for months. All the massive rate cuts, stimulus packages, and floods of money that central banks have been attempting are not working. In fact, they are failing right now. China is teetering on the edge of an economic abyss, and it is poised to pull the entire global economy, including us, down with it. The banks overseas are scrambling because they are right on the verge of insolvency. Loans are turning bad faster than they can cover them. Both everyday people and businesses are refusing to take on new debt, meaning the entire economy continues to slow down, regardless of how many times the central bank tries to stimulate growth or inject liquidity. To understand the absurdity of this situation, banks are literally begging clients to take out loans and pay them back almost immediately, with the bank even covering the interest costs. This shady practice is known as quick lend and recover, and its only purpose is to manufacture numbers so that the balance sheets look good on paper. They are actively hiding the painful truth about the economy because while they can make money cheaper and more abundant, they cannot force people to borrow, to spend, or to invest. This matters immensely. Economic booms are fueled by the expansion of credit. When credit slows down or worse, begins to contract, it immediately drags economies into recession. Here in the United States, we are already seeing signs of credit contraction, which strongly suggests that our own economic growth is headed sharply downward in the quarters ahead. History shows us that when lending dries up, growth crashes. When we look specifically at China, the data confirms the danger. Their loan growth is slowing down to a record low of 6% year on year. This is the worst performance seen since 2003. It makes perfect sense, then, why the Chinese economy is headed for a recession and why we are facing the same risk here. There simply isn't enough new money circulating or being created to cover the enormous mountain of debt accumulated over the last few years, let alone spark any real sustainable growth. This is the root cause of the recessionary feelings many of you are experiencing daily. Beijing's solution to this mess was simple: tell the banks to lend at least as much as they did last year. Since the real demand for money is nowhere near that level, banks have been forced to whip up these phantom loans out of thin air. Even households overseas are borrowing less. Think about why people stop borrowing money. They are worried about losing their jobs. If you don't have a job, you cannot pay back your loan. We see a clear historical correlation between rising unemployment and downward pressure on lending because businesses won't borrow to expand and consumers cannot borrow because jobs are scarce. This is exactly the risk we face right now. We may not have seen the unemployment rate skyrocket yet, but based on what we see in commercial lending, any further slowdown threatens to completely unwind the labor market. As global demand continues to fall, unemployment will spike and credit will shrink even further. All those attempts at interest rate cuts won't fix this fundamental problem. Here's the secret the banks are concealing. They flat out stop lending when loan defaults and delinquencies start climbing. When the rate of consumer defaults rises, banks simply will not extend new credit. They worry about getting their money back. We know defaults are already expected to rise here in the US. That explains why the liquidity injections given to Chinese banks are not flowing into new loans. The money is simply being parked safely in government bonds. The banks are choosing safety over risk, defying their own government's wishes in the process. They are terrified. The core reason businesses are avoiding borrowing is simple. Global demand is crumbling. The Chinese manufacturing machine relies far too heavily on the rest of the world. Between the general slowdown and ongoing trade friction, they are taking a brutal financial hit. Exports in October fell by 1% from the previous year, marking the first decline in 8 months. Shipments to all nations except the United States rose by 3%, but this was not nearly enough to compensate for the decline to America, which fell by more than 25%. If this trend continues, and all evidence suggests it will, even more loans will go bad. This explains why the banks are slamming the door shut on new lending. And demand is only half the story. While the services sector showed some expansion in October, that growth was the weakest in 3 months and was artificially supported by holiday spending and travel. Once the holiday boost is over, you are left staring at an economy drowning in debt with growth grinding to a halt, or worse, entering a period of stagnation. If you are betting on services to save the day, history suggests you should reconsider. When manufacturing and construction slump, services inevitably follow right behind. This brings us to the biggest problem of all. The real estate developers are bleeding out. One major developer saw its bond values crash after a major shareholder demanded collateral for approximately 20 billion yuan worth of previously unsecured loans to ensure those debts could be repaid. This massive, unstable developer debt is exactly why the banks are creating fake loans. They are facing what amounts to a massive looming request for collateral because property prices are in free fall, and they know this debt will likely never be repaid. What you are witnessing is not just an isolated issue, it's China's entire banking system teetering on the edge of collapse. The central bank is trying a desperate measure, a last ditch effort to make its currency a global currency, hoping to use that mechanism to bail out its banks. They are promoting the currency's role as a funding currency, supporting the use of various funding products, and making it easier for overseas corporations to obtain the currency. The major selling point for this international push is the currency's cheap borrowing costs. This presents another reason why the banks are terrified to lend domestically. They are already operating with razor-thin margins. If a single wave of bad loans hits, they can't cover the damage. Now, Beijing is dangling even cheaper credit around the world, piling more risk onto banks if those global borrowers default. This is why banks are hoarding those liquidity injections to buy bonds instead. They desperately need safe capital and guaranteed interest, which they simply are not certain they can get by lending money to struggling businesses. The central bank appears to be in complete denial. While experts overseas retracted calls for further stimulus, the central bank maintains that the economy is still on track to hit growth targets. But how can they believe this when manufacturing has slumped for years, the services sector is stagnant, and the global slowdown is accelerating? This pressure is not just isolated to overseas banks. It's being felt all over the world. When credit slows or contracts, cutting interest rates is the standard response by central bankers because they assume rates are too high. But the charts show that cutting rates when loans are contracting makes no difference until the system hits rock bottom. This is the danger we face right now. As our own central bank appears to be far behind the curve, they aggressively cut rates, praying it will spark borrowing. But the painful truth is that after decades of massive credit binges, you need endless accelerating expansion just to service the existing debt and meet targets. When that expansion stops, you get a recession, or worse, a financial crisis. The banks overseas are terrified they will be the next system to fail. This phantom loan fiasco is the clearest signal we have that the entire global debt-ridden system is cracking under pressure. When it snaps, the shock waves will hit all of us. Expect the central bank overseas to capitulate soon, cutting rates and pushing its currency overseas as much as possible. But understand this, it will not stop the collapse if global demand continues to crater and delinquencies pile up. We are talking about the potential for a complete banking meltdown. Do not ignore this warning. To protect yourself, consider moving some of your assets out of anything tied to that foreign market. We are facing unprecedented instability, and choosing safe havens is paramount. Now, as challenging as these times are, chaos always creates opportunity. While others panic, smart planning allows you to position yourself ahead of the market. There are specific ways to navigate this current chaos and capitalize on the signals the market is sending right now. If you found this analysis insightful and want more information on how global financial risks impact your investments and your future, please make sure you hit the like button on this video. And if you haven't already, click that subscribe button and ring the bell icon so you don't miss our next warning. Thanks for watching, and we'll talk again soon.